Retirement is about to look very different. President Trump has just signed an order that will allow 401k and other retirement plans to include new types of investments, things like private companies, real estate, commodities, infrastructure, and even cryptocurrency. Up until now, these alternative assets were mostly reserved for the wealthy or big pension funds. Soon, millions of everyday savers could have access too. Supporters say this could mean higher returns and better protection from stock market swings. Critics warn it could also bring higher fees, longer lockup periods, and more risk, especially if you don't fully understand what you're investing in. In the next few minutes, I'll break down exactly what's changing, when it's happening, and the most important things to consider before you make a move. What's changing in retirement plans? For decades, most 401k accounts have been limited to stocks, bonds, and mutual funds. They're simple to track, easy to sell, and prices are updated daily. That's about to expand. Soon, plans will be allowed to offer private equity, investing in companies before they go public, think SpaceX-level opportunities, real estate projects, commodities and infrastructure, cryptocurrency like Bitcoin, lifetime income products that pay you for as long as you live. This isn't a pilot program. It's a permanent policy change that will affect millions of savers once it's fully implemented. The costs and risks. Here's where things get tricky. With a mutual fund, you might pay as little as 0.3% per year in fees. Private equity or alternative funds can charge 1 to 2% in management fees plus up to 20% of profits, called a performance fee or carry. There may also be extra transaction or custodial fees buried in the fine print. Valuation is another big difference. Public stocks are priced daily. Many alternative assets are valued only a few times a year, sometimes just once, based on estimates rather than open market prices. That means the number on your statement might not reflect reality. And then there's liquidity. You can sell mutual funds in a couple of days. With private equity or infrastructure, your money could be locked up for years. Even scheduled redemptions can be delayed or limited. Why age and timeline matter? If you're decades away from retirement, you have time to ride out market ups and downs. But if you're already retired, or close, a locked-up investment that loses value could directly hit your income. That's why many experts recommend keeping alternative assets to 5 to 10% of your portfolio. Younger investors might go higher, but for retirees, too much exposure could be risky. Potential advantages. This change isn't all risk, there are real benefits. Access to new areas of the economy, private companies, large-scale infrastructure, specialized real estate, different performance cycles, returns that aren't tied to daily stock market swings, possibly higher long-term returns, especially in growth-stage private equity or high-demand real estate, unique income sources, steady cash flows from things like toll roads, utilities, or rental properties. In short, more tools to build a portfolio tailored to your needs, if you use them wisely. Crypto in retirement accounts. Yes, cryptocurrency will be included. If you're new to it, crypto is purely digital, no coins, no bills, and prices can change drastically in a single day. While some people have made huge profits, others have lost everything just as quickly. Bitcoin and Ethereum are the most established, but they can still swing more than 50% in a year. Crypto isn't backed by any government or FDIC insurance, and if your trading platform is hacked or collapses, you could lose it all. Regulation is still developing, and taxes apply on every trade. Treat crypto like a high-risk side bet, not the core of your retirement plan. Who might benefit the most? Younger workers with decades to invest, people with other steady income sources, like a pension or rental income, investors with diversified portfolios and access to professional advice. But for retirees relying on a single account for everyday expenses, the risks may outweigh the rewards. Final thoughts. Alternative assets don't update in real time. Values can be estimates, fees can be high, and liquidity is limited. Still, Supporters see this as a way to give everyday savers the same opportunities as big investors. The Department of Labor and SEC have 180 days to write the new rules, so most people won't see these options until 2026, and even then, not every employer will offer them. For now, watch for updates from your plan administrator. Research any new options before jumping in. Only choose what you fully understand and are comfortable holding long term. These rule changes could reshape retirement investing for decades. The question is, will you embrace the new opportunities or stick with what's worked so far?